Alright, today is Sunday, October 25th, and this is a market review for the stock market activities on Friday and an outlook for the upcoming week. We do have a lot on the agenda today. We will revisit all the earnings that we have not covered from last week, and of course we do have all the usual charts, and in the conclusion of this video we will preview the threats for the market this upcoming week and the important events in the economic calendar. With that being said, here we go. The Dow Industrial Average closed in the red by 28.09 points, or a decline of 0.10%. The Nasdaq managed to close in the green on Friday with 42.28 points, or a gain of 0.37%. S&P 500 also in the green by 11.90 points, or a gain of 0.34%. And here is the sector's performance on Friday. Communication services led the way in gaining the gold medal. The silver goes for consumer cyclicals and the bronze for financials. The laggards of the day were technology, basic materials, and real estate. Very interesting here that technology is joining the laggards. When you switch to the weekly sector's performance, the picture could not be any clearer here. Communication services, due to Facebook's outperformance, leading the week and gaining the gold medal. For silver, energy, and financials get the bronze in the weekly performance as well. But you see technology's out of place here, leading the laggards, followed by consumer defensives and healthcare. What's going on in the futures market? Here's what's going on. Crude was down over 2%, yet the dollar was also trading in the red, and we didn't see an outperformance of gold and copper. Very interesting action here. You see the divergences, and I believe that it will sort all these divergences in this upcoming week. How about softs? You see an outperformance by OJ, yet the decliners led by lumber, coffee, and cotton. Platinum outperformed the rest of the metals futures. Lean hogs back in the green in meats, and you see an outperformance in grains across the board. Grains been on a tear for the last few months, and of course hand in hand, if you're watching the stock market, you know what's going on with the stock of deer. All-time highs, and that comes in correlation with the prices in grains futures. Moving on to the big casino, the options market. Apple back on top, beating Snapchat and regaining the first place. With 1.5 million contracts traded on Friday, about 63% of those were calls. Snapchat again at number 2. You see the breakout of Snapchat forcing all the short covering and creating tremendous rallies, just like we saw in Tesla stock last year. But here it is, Snapchat with 1.18 million contracts, 62% of those were calls. Tesla number 3 with 1.1 million contracts, and about 50% of those were calls. You see the percentages of call options dropping last week. When I say last week, we're still technically in the week and Sunday, but we're talking about the trading week, and that is due to a change in sentiment. We're more careful now, and you see a little bit of bearishness crowding in market participants. And what led the volume in options trading on Friday? Snapchat, they're buying the 42 calls expiring this upcoming week. And also a notable mention here, because it is tied to the first volume leader. We do have a $7 put for Ford, and this is expiring November 20th. So a bearish bet here against Ford. And when we move on to the change in open interest and we see the gain in open interest, it is primarily in the $25 strike for Bank of America. You see yields rising and traders are betting, and there is further gains for the banking sector here. And we see some bearish bets here against commodities in gold and Vale. Of course, this is an iron producer from Brazil. PBR, same thing, an oil producer in Brazil. So bearish bets, and they are interesting because they could predict a rise in the US dollar in the short term. We also see the 28 put for Twitter also gaining a massive number in open interest. Bearish bets on Twitter, you'll see more of them as we go to interesting trades. And the bet here is very simple. If we are betting that Biden will become the next president and we will see a blue wave of some sort, then guess what? Trump was the best thing that ever happened to Twitter in a long time. Remove Trump, and perhaps Twitter becomes less relevant and less active, and that is bad news for Twitter. On the Maverick Wall Street channel, we will do a pre-election trade, and in that video, we will discuss how we can play a Biden win or blue wave result post-elections, and one of the trades, of course, is going to be shorting Twitter. Moving on to the decrease in open interest. We're trying to see which trades are being closed by option traders here, and you see taking profits off the table from General Electric and Wells Fargo. Wells Fargo had a decent week due to the outperformance of the banking sector, and that of course came hand in hand with the rally in yields. And continuing for the bearish trade on Ford, you saw them opening the $7 put for Ford, and here we go. This week they closed the $8 call. Moving on to some interesting trades, and we will ignore, of course, the Snapchat trades because Snapchat right now, and you don't want to be in that trade anyways because you could get burned if you bet the wrong bet. You could see further short covering and massive rallies in Snapchat, but you could also see massive dumping. So we'll stay away from Snapchat because there are better opportunities elsewhere. We see a bullish bet here for Norwegian Cruises buying the 21.5 calls expiring this week. This is a bet, of course, because Norwegian is reporting this week, and the bet is that we will see a recovery in cruises, specifically in reservations for future trips. This is a big bet, but when we cover the results of American Express earnings, you will see that we are seeing a recovery in spending when it comes to cruises. So that is the beauty of reviewing earnings. A totally different company, American Express, can tell you lots of indicators about other sectors in the economy, including cruises. What about the trade for Uber? You see him buying the 42.5 calls and also buying the 29.5 puts. What's going on here? These are of course all expiring in November, but when you read the tape, it is a very smart trade actually. It is the same trader or traders basically betting that there will be a massive move in Uber stock after the elections due to Proposition 22 in California, which will have lasting implications on Uber and how it operates in its biggest market, California. We don't know whether the proposition is going to pass or fail. Therefore, why not make a bet for the upside and for the downside on extreme volatility? And all in all, you're paying 45 cents for the upside and 36 cents for the downside. All in all, you're spending 81 cents for the trade, and it doesn't matter if Uber moves impulsively higher after the elections or impulsively lower, you will still make money. Very smart trade here. And to validate my theory, take a look at the expiration date. For the call, it expires on November 6th. However, for the put, it expires November 20th. Very smart structure here for the trade. We also see a bearish trade for Disney buying the 115 puts expiring December 4th. And perhaps this is a bet for the resurgence of coronavirus, that we will see closures of Disney in California and Florida and perhaps other places around the world, and that would have a negative impact on Disney's shares. I'm a shareholder of Disney, and to protect my shares, I followed this trade and I did buy the 115 puts expiring December 4th. Continuing, we see a bearish bet here for AMD. They're buying the 77.5 puts expiring this upcoming week. We know that AMD is reporting earnings this week, and the stock rallied about 2% on the heels of the big bomb of Intel's earnings. It's becoming very clear that AMD is eating Intel's lunch when it comes to the data center business. However, AMD stock is already pricing all that information and it rallied too high. So the bet here is whatever earnings they're going to have, the stock will move lower because the results are already baked in. And the threat here and the risk is to the downside, that if anything doesn't live to expectations in the earning report of AMD, the shares could go and drive lower. And we see bearish bets for Oracle, buying the 54 puts expiring in November 20th. And again, you see a bearish bid for Twitter, buying the 47.5 puts expiring also November 20th. And perhaps these are bets on a Biden's win. We talked about how a Biden's win will impact Twitter negatively. And we know that Oracle is one of the firms that benefited from Trump's administration, specifically the TikTok deal. So this is a bearish bet for Oracle, expecting a Biden win. And you see up at the bottom of the screen right there, Tesla, they're buying the 385 puts expiring this week. Tesla, technically, from a charts perspective, looks like it's about to break down. And it makes sense here, of course, that traders are betting on the downside. This is an interesting trade. You pay $1.88 and you don't really need Tesla to drop 8 or 9% to make your money. A 5% drop in Tesla stock early in the week will put these puts in the profitability zone. And now to the headlines that shaped the day. Starting with the stimulus fiasco, which is of course coming to an end. But this is what we heard on Friday. The White House Chief of Staff Meadows saying that he's hopeful for a COVID-19 deal in about a day or so. What does he mean by a day or so? It could be a day, could be 2 days, could be 5 days, could be a month, could be, we get an election in a week, and you guys are probably going to be out of office. And you see that negativity, of course, reflecting on the propaganda minister himself. Kudlow is now saying that he does not know whether a stimulus bill can be done before the elections or not. Remember that the propaganda minister on Thursday showed his face on television and he said, "It looks and it feels like an optimistic morning." Well, we know that that was a result of a little splash of rum in his cup of coffee. Moving on. And here we go. This is of course on Friday. The headline says the chances of passing a stimulus bill before elections day drops to virtually zero if it's not done tonight, meaning Friday. So now we're done. We're at 0% possibility that we will see a stimulus deal before the elections. So what happens to all the pumps we got the last few weeks on stimulus hopes? The hope turns into hopium. And here is a bit of interesting news. Apple and Netflix are now in talks with MGM to take the movie directly to streaming. The likelihood is theaters would be closed for a lot longer than we expected, and by the time it is feasible for them to open, they will be bankrupt. So it makes sense here, instead of waiting till a release for next year or perhaps 2022, to just release the movie directly on Apple or Netflix. And of course, the deal will cost over $100 million. So who has the deeper pockets here? Apple does. They can afford to pay over $100 million to MGM and have the movie premiere on Apple Plus. And that would be a good advertisement for Apple Plus, and you will see the downloads and perhaps the subscriptions for the platform increasing. Now, mind you, of course, the Robin Hoodites will look at this headline and they will buy stock at MGM Resorts thinking that it is the producing company. There's MGM, the casino, and that there is MGM, the movie studio. Different companies, just an FYI. And speaking of Apple, of course, we now know that the Apple iPhone 12 in France will include the charging brick and the AirPods in the box. Maybe the American consumer should learn from the French consumer, because the French told Apple some very bad French words. If you don't include the AirPods and the charger in the box, we're not buying. And Apple, of course, succumbs to the threat and they include everything in the box. But the zombie consumer here in the US will just go with the flow. If they tell you that they're going to send you an empty box with no phone, they'll still buy it anyways, because we are a brain-dead zombie society. So maybe the US consumer needs to wake up and demand better treatment from Apple, just like the French consumer did. Moving on to some vaccine-related news. And of course, we've heard the FDA now officially approving the remdesivir treatment from Gilead. That was good news for Gilead, and you saw the stock rallying this week, but we do have earnings coming up this upcoming week, and perhaps we will see Gilead stock fading. Now remember that the remdesivir was a tax-funded drug, yet they're charging us $3,000 a pop if we get sick and we need it in the hospital. Just a little FYI right there. Moving on. What's going on with the AstraZeneca trial? We heard about the patient who died in Brazil, and now they're saying, hey, that patient was on placebo, who was not on the drug itself. And we heard about the patient who got sick in the US, resulting in a hold for the AstraZeneca trial. And now we know that they're resuming officially here in the US as well. Good news for AstraZeneca and the vaccine optimism overall. The side effects of this drug may include, but not limited to, turning you into a brain-dead zombie. Moving on to another piece of news for Tesla. Tesla's recalling about 50,000 vehicles in China over faulty suspension systems. 50,000, that's pretty much everything that Tesla produced in the year, because we know they barely produce cars anyways, yet the valuation is worth the entire car industry combined. And maybe this is the result of all the runs to Home Depot that Tesla been doing just to meet their production numbers and their delivery numbers. Quality engineering right there. And now let's move on to review some earnings we had on Thursday and Friday, starting with Coca-Cola. Coca-Cola beat revenue expectations due to the limited reopening that is, of some theaters overseas and stadiums over here. So that boosted the results a little bit, but nonetheless, they were bad, and I'm a shareholder of Coca-Cola, and I did not like the results. They're bad. You can look at the results in two different ways. They're bad, period. Full stop. However, the good news is that Coca-Cola is restructuring their products portfolio, and that is a good step. They're trimming the fat and all the underperforming brands in their products category. They're scrapping over 200 drink brands. And among these names, of course, you might hear some of your favorites: Tab, Zico, Odwalla, even Powerade and Smartwater, all of them gone. Goodbye. We're just gonna stick to old school Coke. And here are the results from Coca-Cola. Year over year, the revenues are down 9% still. We were hoping for an improvement, perhaps down 5%, but they're still down 9%. It's a slight improvement from last quarter, but it's still bad, and it shows that the path for recovery for Coca-Cola is still ahead. And when you look at the net income, and this is the biggest bomb here, down 33% year over year, because it's not just that the revenue's down, but their expenses are up. Expenses are increasing during COVID. And you see a double whammy here against Coca-Cola. And looking at their regional performance, you see Europe, Middle East, and Africa down 7%. Latin America is the worst here, down 23%. North America not bad, down 2%, because we are fat slobs and we're still drinking our Coca-Cola no matter what. Asia Pacific down 9%. Bad numbers across the board, yet beating expectations. But speaking of bombs, let's talk about Intel, because this one was a heartbreaker. I was expecting Intel to beat here and to surprise us to the upside, even with the slightest good news. The bar was so low for Intel to beat and for the stock to rally, and I was waiting for the results before I add Intel in my portfolio. But now you know that I wouldn't be anywhere near this name because the results were abysmal, to say the least. And here is what's up. Revenue year over year down 4%. Not bad. Here's the problem. Net income down 29%. But even that was not a problem. Here is the problem, the real one. In the data center category, which is the most important category in any chip manufacturer, is the highest growing segment right after gaming. We know Intel isn't anywhere near gaming when you compare it to Nvidia and AMD, and that is the biggest spot of weakness for Intel. But when you look at the data center, overall, they're down 10% year over year. But in certain category, such as the Internet of Things, they're down 33%. That is just unacceptable, and it shows that Nvidia and AMD did a real number on Intel's margins and market share. And when you read the earnings report, it looks that the management is pretty much waving the white flag. They're not even trying to sugarcoat it, and listening to the conference call, they're pretty much indirectly saying, please don't buy our stock. We suck so much, you don't want to buy our stock. Now, one slide of optimism, or even trying and attempting to twist bad news into good news, just like any other company is doing. Go ahead and look at Coca-Cola's presentation. Their numbers are horrible, but they did every trick in the book to show you some optimism and good news. Intel didn't even try. In the story. And you see the stock was down over 10% right away. What about AT&T? This is a boring company, of course, a utilities company with high dividend. A lot of people are interested in buying AT&T. And the theory here is the stock already bottomed and you can catch the ride higher and the high yield. So let's take a look at AT&T's results. Mobility and wireless, we're not expecting a drop here. People are not going to cancel their phone's subscription no matter what. But when you see their entertainment segment down 10% year over year, business services down 2.5% year over year, and of course the Warner Media segment down 10% year over year, not doing so well in the entertainment sector here. Movies, production, down across the board, whether you're talking about Disney or Warner Media or Sony, that business is down. It is expected, but we have a significant weakness here in the Latin America segment, 19.3%. Now, are you noticing a theme here? Whether we talk about Coca-Cola or AT&T, we're seeing significant weakness in the Latin America segment. Even in Mondelez's earnings last time around, Latin America was the weakest spot. You're seeing that Latin America got hit very hard from the coronavirus. And unlike us and European countries, they can't just print money out of thin air and give hands out and stimulus to their population. So there is a severe economic crisis in Latin America, and the consumer spending recovery in that region will take a lot longer than many economists expect. Keep that in mind. Moving on to some airlines earnings, starting with American Airlines. We don't even need to show you the revenues or profits. You know that's gonna be horrible. That's not what the street was watching. The number one key performance metric for the airline sector this season is the rate of cash burn. And American Airlines managed to reduce their cash burn in the third quarter from 58 million to 44 million per day. That is significantly higher than Delta, Southwest, or even United. And they're saying in the fourth quarter, it will be between 25 to 30 million per day. That is still higher than Delta, Southwest, and United cash burn in the third quarter, which tells you that American Airlines is the weakest link here, and this company will be the first one to go down if we see bankruptcies in the airlines sector. But contrast the results from American Airlines with the results from Southwest, the best operator in the segment. Southwest managed to reduce their cash burn from about 23 million bucks a day in the second quarter to about 16 million bucks a day in the third quarter. This is very close to Delta's results, but it is significantly better than American and United Airlines. And of course, you saw the contrast between the performances for all the airline sector. Southwest and Delta managed to outperform the rest of the airlines, but notably American Airlines actually traded in the red. Very interesting market action right there. And now let's move on to the last bit of earnings we had on Friday for American Express. Amex earnings, of course, are very important because they provide us with information not just for the results for the company itself, but also for different sectors in the economy. Now, looking at the earnings, right away you see that the results are horrible across the board. Revenues down 20% year over year. Net income down almost 40% year over year. And right away you saw the shares of Amex down over 3% right away. Now, having negative revenue growth and net income growth was expected from Amex. However, having net income decline by 40% exceeded expectations to the downside. But what the market is really looking for is a sign of recovery. And for that, we're moving on to the next chart. And right away, you see the business growth for their billings is improving slightly. The problem is that we assumed a V-shaped recovery right away. But what you're seeing right in front of you couldn't be further away from a V shape. It is at best plateauing at this point, and of course the fear and the risk is that we're gonna go into a double dip pattern. So let's move on and see what's behind the lag here for Amex growth. When you break it down into business segments, you see that the small and medium enterprise is recovering a little better, but bear in mind, of course, that did not drop as much as large and global corporations. This segment dropped over 70% when the crisis hit, and right now we saw a slight recovery, but it is still hovering above 50%. It's been about 4 to 5 months since the quote-unquote recovery started, and all we've seen here is very slight and marginal recovery in spending, specifically for large and global corporations. So when they release bullshit numbers, economic numbers, saying that corporate expenditures are rising, well, this is not what Amex are telling us. The results, that is. And let's move on to more specifics here. You see that the restaurants sector is recovering a little better than the rest. You actually see a trend lower for lodging. That is bad news for hotels stocks. Airlines plateauing, and that comes in correlation with the passenger travel data. It's been static and plateauing for months right now. But perhaps the most interesting rise here is for cruises. Cruises went down significantly, but since June, you saw significant recovery. It is still at the bottom. I understand. It is horrible and miserable, but it is recovering faster than any other segment. Combine that information with the bullish bets that we saw in Norwegian cruises, and perhaps it would not be a surprise when Norwegian reports that we will see the spending on future reservations getting a pump. Furthermore, and this is why I love Amex earnings report, lots of information here. When you break down the growth per region, you see that the US managed to climb back higher than any other region, and it is outperforming the rest of the world. But it is interesting that you see Europe trending downward since August. That is a very interesting move and will have further implications in many different companies and many different segments in the market. We're seeing weakness in Europe overall. That comes, of course, hand in hand with the harsh lockdowns in Europe as a result of the resurgence of the virus. What happens if we break down the growth per state in America? We see that the southern states, such as Georgia, Florida, Texas, outperforming the North and the West. These, of course, happens to be red states that, yes, had a big surge in coronavirus. However, they reopened earlier and they're more relaxed in their lockdown approach. And you see the results for Amex in Georgia, Florida, Texas recovering faster. Notable here, of course, the New York area. And you see that the recovery in New York is not doing so well because of the harsh lockdown in New York, and the rules of reopening in New York much harsher than the rest of the nation. Of course, they have the genius mayor over there, but also New York City specifically is very dependent on tourism. Without tourists, you're not going to see a recovery in spending. And now, moving on to the heat map analysis, starting with the performance on Friday. Right away, you saw a recovery in the big boxes of tech, excluding Apple, but the notable outperformer, of course, Facebook and Google, of course, on the heels of the good results from Snapchat. You saw Intel down over 10% due to the earnings. American Express, you see at the bottom left of the screen, AXP down over 3.5%. AT&T in communication services, the symbol is T, that was down too. So the names that reported earnings did not do so well. Now look at the airline segment right in industrials. You see that it is overall green, but we see a small red box right there. That is American Airlines. And it is very interesting that the market distinguished between the performances of, say, Southwest and American Airlines, rewarding Southwest shares higher and selling off shares of American Airlines. Very interesting. We see, of course, outperformance from Pfizer. Ever since we heard the news that the vaccine will be the first to enter the market, you saw shares of Pfizer climbing higher and higher. Healthcare insurers, whether it is United or Anthem, Cigna, all in the green. This is another bet on Biden's presidency. We also saw outperformance for apparel, retail, casinos across the board. The momentum from Las Vegas Sands earnings continued all the way till Friday. And you also saw beer outperforming. If you look at the right upper corner of the screen, you see the beer segment lighting bright green, and that was due to the good results from Sam Adams. And now let's take a look at the weekly performance for the heat map. What do we see here? Starting with technology. Right away you see the underperformance of the tech sector for this week. The notable outperformer, of course, is Uber. Uber had a big week this week, but other than that, you don't see an outperformance in the sector. The weakness is notable in Intel, IBM, Apple. Intel and IBM reported earnings. Apple will report this week, but you saw significant exodus here from the tech sector prior to earnings. You saw Salesforce down, Shopify down, Square down, Adobe down, Cisco, chips across the board, Nvidia, Lam, all closing in the red. Moving on to communication services. The outperformance, of course, for Snapchat. And Trader made bullish bets for Facebook and Google, assuming that Facebook and Google will follow through and see a recovery in social media advertising in the third quarter. You see Netflix down over 8% this week. Of course, they had earnings. They did not meet expectations, and there you go. And this is just a warning shot for all the earnings to come, that if you miss expectations by the slightest margin, the market will have no mercy. Furthermore, you see the lack of momentum in momentum stocks, evident by the performance of Zoom down over 8% this week. And you see Tesla also reported earnings in the consumer cyclical sector, down over 4%. Likewise, Peloton also down over 6%. Peloton been an outstanding performer in the last few weeks. And now you see it trending lower, and the tide is turning against all the hot stocks that benefited from the momentum of the lockdown. We're now asking questions. Are the valuations really justified at this point? And the earnings from the third quarter will give us the answer to that. Names that fail to meet expectations will be punished severely. Amazon down over 2%, yet you see the outperformance of the reopening sector, whether it is casinos, resorts, cruises, restaurants, hotels. But bear in mind that all of this optimism for the reopening trade, whether it's airlines, cruises, etc., will evaporate if we continue to see massive surges of the virus across the globe, and if we see further delays in the vaccine development and approval. Let's check on the consumer defensive sector. Right away, you see Philip Morris, the tobacco sector, trading severely in the red for the week. They had earnings, missed expectations, and you know the rest of the story. You also see KMB, Kimberly-Clark, also got whacked this week for failing to meet the growth expectations. All of these names ran really high. If the growth is already priced in the name, you will see a sell-off. We saw Procter & Gamble had massive growth, and the market cut some slack for the name, but it still managed to sell off just a little bit. The growth in Kimberly-Clark, different story. Did not meet what the stock is already pricing. Moving on to the banking sector. You see an outperformance here, specifically for regional banks, due to the rise in the 10-year yields and beyond. Regional banks are more tied to yields, and you see the outperformance right there. Notable, of course, the credit services, whether it's MasterCard or Visa, Amex, all down, and that could be, of course, an indicator of the future of consumer spending, or the more reasonable explanation that the names ran too high, and when they report, you will see that the results are already priced in, beyond priced in, and the stocks need to reprice lower. Continuing, Any interesting activities in the healthcare sector? Not really. Energy, we saw earlier gains for Exxon and Chevron, and then they gave it all up by the end of the week. Materials, interesting outperformance for copper. Freeport-McMoRan is the name that comes to mind. The weekly gains are over 7%. Utilities managed to outperform too. Across the board, real estate, it is a mixed picture, and the same can be said for industrials. You see General Electric having a pretty good week, but we're also seeing bullish bets being taken off the table, so expect a downside from here on for General Electric. Airlines outperforming because they managed to reduce their cash burn. Exception, of course, is American Airlines, the laggard for Friday and for the week as a whole. You also see railroads getting whacked. Union Pacific down over 10%. Bear in mind that they had very sizable gains in the last few weeks, but yet again, when a company reports earnings, the price is too high. Any slight miss here or there will cause the stock to retreat significantly. We'll see a lot more of that kind of action in this upcoming week. Before we move on from the heat map analysis, let's take a look at the weekly performance for ETFs. Right away, the notable action is the gains in the short triple Qs. This is the inverse index for the Nasdaq. And the mirror image, you see a big decline of 4% or so. For the T triple Qs, this is the Ultra Pro Leverage Index for the Nasdaq. We saw a bad week for technology. This is the result. But also notable outperformance for XOP. This is an energy ETF, and it is not reliant on Exxon and Chevron, but instead it takes a wholesome approach to the sector, specifically for gas. What about financial ETFs? You see the KRE, this is the regional banking ETF, outperforming significantly. We saw regional banks having a pretty good week due to the rise in yields. Moving on to the rotation trade. Right away you see the comeback stocks and the reopening stocks outperforming momentum, aka stay-at-home stocks. We saw earnings from Netflix that took the name down, but also underperformance this time around from Peloton, Zoom. These are the hot momentum names. Apple, Tesla, all in the red. And check out DocuSign following the lead of Zoom and Peloton, also down over 6% this week. The change in momentum and sentiment for momentum is very important and notable this week. But check out, of course, Facebook and Google. We talked about these two names. Now here is the catch. If Facebook already moved 7% a week ahead of its own earnings, where is the risk? Is it to the upside or to the downside? I would say it is to the downside, because if Facebook underperforms or doesn't meet the same expectations and the results we've seen from Snapchat, the name will sell off significantly. It is a false narrative to say just because Snapchat managed to outperform, that automatically translates into Google and Facebook outperforming as well. It could be the case, but each individual name will have its own unique circumstances. Keep that in mind. Moving on to the other side of the aisle, you see Southwest outperforming significantly over 7%. So did Six Flags, General Motors. Excellent week for GM due to revealing the new Hummer EV. MGM Grand about 10% on the heels of Las Vegas Sands results. And again, the same argument we made for Facebook goes for MGM. Just because Las Vegas Sands did well doesn't mean that MGM will follow through. And when the MGM moves 10% a week ahead of its own earnings, the risk becomes to the downside. Moving on, we see outperformance from Cheesecake Factory, Royal Caribbean, Live Nation, Marriott, big week for Marriott, and Budweiser. So did Planet Fitness. The underperformance here, American Express, we talked about their earnings, Ulta Beauty, and Mondelez. How about we move on to cover some charts, starting with the SPY, the S&P 500, from a 15 minutes perspective. We gapped higher right away in the morning, and then we reached the level of support that we've identified before of 343.70, catching support from that zone and making a V-shaped formation, closing pretty much at the highs of the day. The positive note here is we did make a higher low from Thursday, which could indicate that the SPY could gap higher in the morning on Monday. Moving on to the weekly chart of the SPY, here's a clean chart, no markings or annotations by me. And now let's talk about the bullish case. The bullish case says, yes, we had a mini correction in September, but all we're doing here, we caught a rebound and we're consolidating, making a bull flag formation. And right after the outcome of the elections is made clear, we will move and march higher. Contrast that with the bear case. The bear case says that we're making an ABC pattern, a bearish ABC pattern. We had the first correction in September, we rebounded, or we reached all the way to the highs from where we corrected, and we're failing again. We will see a double top formation, which will lead to forming the C leg all the way to the downside. We'll keep these two perspectives in mind when we trade this upcoming week. Moving on to the Qs. 15 minutes perspective, nothing to see here. Gapping higher, flushing down just like the SPY, and then recovering all the way till the closing bell, closing at the highs of the day and also forming a higher low. What about the weekly chart for the Qs? I see a bearish ABC pattern just like we saw in the SPY. Specifically, when you keep in mind that we do have a tsunami of tech earnings coming this week, all together in 1 week. And any bad news will flush all of them to the downside, and you will see the formation of the ABC pattern. No bull flag here, and there is no good news. I only see bad news and a negative outlook for the Qs from here. Moving on to the dollar index weekly perspective. We talked about a bullish ABC pattern for the Dixie. That is out of the window now, given the fact that we broke the 93 support level. What do we see here for the Dixie? Very tricky and very hard to predict. But when we look at the MACD, we see curling down, crossing to a negative territory. This week will open the floodgates for the dollar to decline. Furthermore, we don't have a stimulus deal and it doesn't look like we're going to have one anytime soon. However, a Democratic sweep will mean a big decline for the dollar. So watch out if Biden wins next week. Actually, it's not going to be next week, but the week after, in November 3rd, you will see the dollar giving up and declining significantly. But for now, if we do see a sell-off in tech, you will see the dollar rising again. So all in all, when we look at the chart, it is inconclusive. It depends on the outcome of technology earnings and the elections. Moving on to gold from a weekly perspective. Here's a clean chart, no markings or annotations by me. And here is what I see. I see the 1925 remains as very solid resistance. We got rejected from it yet again this week. And I see a bearish ABC pattern that will take us all the way down to the 1800s. Moving on to the TNX, the 10 years yield. You saw significant gains this week. And we did talk about an ABC pattern, a bullish one, last week. And you see that took place. And we said bullish activities in the TNX will translate as bearish activities for the dollar index. This is exactly what happened this week. And by the way, the TNX can continue to rise all the way till the resistance of about 90 basis points. After that, you bet that we will see at least a little bit of resistance. Moving on to the chart of the VIX. The VIX reached again to the 30.5 level of resistance and got rejected significantly from that level. The VIX remains in range. The support is 24.8. or we can round that to 25, and the resistance at 30.5. We did see a bullish bull flag formation, and it played out. We broke above the flag line, the upper flag line, but we do need to see continuation of the movement this week. This gotta be the week of the VIX. If the VIX doesn't pop this week, it's over, it's done. You gotta short the VIX. You'll see volatility collapsing even below the support of 25. However, rationally, I expect the VIX to pop this week because in the conclusion of this video, we will talk about the quadruple whammy scenario. So stick around for that. And the last chart we're going to cover is for Apple. We kind of talked about this on Thursday, but we do have a weekly closing. So let's discuss it. It is a bear flag formation. It already broke to the downside, and I see further declines here for Apple. They will report earnings on Thursday, and if we don't see a pickup for iPad and Mac sales just like we saw last quarter, this name will decline significantly and it will take the entire tech sector and the Qs down with it. And now let's move on to conclude this video. Here is the quadruple whammy scenario that I see for this week. Number one, we know that we don't have a stimulus deal right now. It's gone, it's done, it's over. So that is one big defeat for the optimism in the market. Furthermore, this will be the last week of trading before the elections here in the US. So expect more volatility. And the third threat, corporate earnings, stocks at all-time highs. They're pricing an enormous growth in earnings. If that doesn't happen, we will have to reprice lower and multiples have to be cut. And the last threat we have is margin calls. We know that the Robinhoodians and the likes are fully concentrated in tech names and momentum names. If earnings disappoint this week and we see a combination of all the three factors above, no stimulus, volatility, elections volatility, repricing for earnings, you will see margin calls being hit for the Robinhoodians, and the platform will have to dump whatever positions they have. They're concentrated in the Pelotons and the Zooms and the DocuSigns of the world, so expect more pain for these hot names. Also, bear in mind, we do have in the economic calendar on Thursday is going to be by far the most important day in the stock market, not just this month or this quarter, but in the entire year. October 29th will be the most important day for the stock market this entire year. We do have the heaviest concentration of tech earnings on Thursday. Furthermore, we have the GDP number and we're expecting a big pop over 30%. We know that there are people like Fed President Bullard of St. Louis who says it's going to be over 35%. So we'll see if that's true or not. We do have initial jobless claims. That would be very important. And on Friday, we do have very important information for the health of the microeconomy, personal income, consumer spending, core inflation, and consumer sentiment. I do expect a big beat for the GDP number that will come right before elections take place, and the president will brag about it all over the place, which also raises concerns that the number could be cooked. Just keep that in mind. It's been done before. This is not a conspiracy theory. And before I log off, on Monday we have earnings for Twilio, but beside that we don't have anything significant. So we will talk about earnings a little more on Monday. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.